Your index fund isn't as rigged as you think.
Wait, that's backwards. Your index fund is now more rigged than you think. In the last 40 years, Wall Street convinced 58% of Americans to pay someone else to pick their stocks. And most of those stock pickers lost to a computer buying everything. America built a trillion-dollar industry on a promise that 85% of fund managers can't keep. Beat the market. The financial services sector loved that story. 4 main fund types emerged to capture different customers at different price points with a common goal: controlling retirement accounts.
Mutual funds. It's where active managers pick stocks and charge you 1 to 2% annually.
Index funds. That's when a computer buys 500 companies weighted by market cap, charging you basically nothing. ETFs. Hidden index funds that trade like stocks, with thematic versions charging more for concentration. Hedge funds. Those are the private funds for rich people with extreme fees and minimal regulation. 4 different structures, 4 different fee models, 4 different ways the system extracts value. But here's the catch. Most of them either charge you to lose or they win by accident, which is like hiring a mechanic who charges 20% of your car's value every year, except half the time they make it slower and you still pay them. When 4 fund types control trillions in retirement savings and most trail a simple index, that's not portfolio management. That's a fee structure. It's like a casino where you're paying the dealer whether you win or lose, except the dealer told you it was an investment account. Because once you see how the rigging actually works, the concentration, the fees, the incentives, everything changes. So, who's the villain? Start with the most obvious one, mutual funds. Here's how they work. You give money to a fund company, they hire a portfolio manager. That manager picks individual stocks. The fund charges fees, the manager gets paid, you get whatever's left. Sounds reasonable, until you check the scoreboard. 85% of actively managed mutual funds underperform the S&P 500 over 10 years. 85%. That's not a rounding error. That's a business model. If 9 out of 10 restaurants gave you food poisoning, you'd stop eating out. But 9 out of 10 fund managers lose to the index, and people keep paying them. Why? Because the winners scream loud about their returns. The losers quietly disappear from the rankings. It's survivorship bias wrapped in quarterly reports. And the fees compound like cancer. 1 to 2% per year doesn't sound bad until you do the math. If the S&P 500 returns 7%, and your mutual fund charges 1.5% annually, that 1.5% compounds against you every single year. It's not 1.5% of your gains. It's 1.5% of your entire portfolio value every year. Your fund returns 6%. Takes 1.5%, you net 4.5%. Meanwhile, the fund complex publishes marketing about consistent performance. Here's the part nobody mentions. Mutual funds exist because brokers profit from them, not because they work for investors. A broker placing clients in index funds makes almost nothing. A broker recommending mutual funds gets trailing commissions, referral bonuses, revenue sharing agreements. Your advisor isn't picking the best fund. They're picking the fund where they get paid best. That's the trap. Legitimacy as camouflage. The fee structure guarantees underperformance. The compensation system guarantees recommendations anyway. So what's the alternative? Index funds. Now here's where it gets interesting, as index funds do the opposite of everything mutual funds promise, and somehow they still find ways to cost you money, just slower. An index fund mechanically buys all 500 companies in the S&P 500, weighted by their market capitalization. You're not paying someone to pick winners, you're not funding research teams. You're paying a computer to replicate an index. Fees reflect that. 0.02 to 0.05% annually. Almost nothing. So index funds should be the obvious answer, right? Just buy the market and forget about it for 30 years? Not quite. Here's the problem. Indexing concentrates your risk in ways most people don't realize, especially right now. The Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, represent roughly 30% of the S&P 500's total market value. When you buy an index fund, you're not buying 500 companies equally. You're buying them weighted by current market cap, which means you're not diversified, you're concentrated. Your broadly diversified index fund is really a leveraged bet on 7 tech companies. That's not 500 independent holdings, that's 7 mega cap stocks dominating your returns. And those 7 trade at valuations between 35 and 40 times earnings, while the rest of the market averages 22. So you're systematically buying the most expensive stocks, at scale, automatically, every time you contribute to your 401k. Fees are transparent and low, but concentration risk is higher than anyone admits. The genius of this? When the correction happens, and historically it always does, most people blame their timing instead of questioning why index construction concentrates capital at the top. Meanwhile, the financial services industry collected trillions in contributions with zero scrutiny of the concentration building underneath. Index funds beat mutual funds on fees. No question, but they're not risk-free. They're just lower cost risk, with structural concentration baked into the design. The fees are honest, the construction isn't. And the curveball? Now here's where most investors get confused. ETFs look like index funds, trade like stocks, feel modern and efficient, but they're a different structure entirely. And that structure creates new problems. ETF stands for Exchange Traded Fund. It's a fund that trades continuously on stock exchanges during market hours. You can buy and sell all day, set stop losses, execute short-term strategies. That structure changed everything about how funds operate, and not always in long-term investors' favor. First, the good news. Most ETFs track major indexes with minimal expense ratios. They're tax efficient because of how the creation-redemption mechanism works. But here's the trap. That same structure enables behavioral disasters. Because ETFs trade like stocks, they spawned an entire ecosystem of day traders and algorithms, treating long-term investments like casino chips. Your intended 30-year holding is surrounded by participants flipping the same fund thousands of times per day, based on microsecond price movements. This creates volatility clustering. Short-term traders generate price swings. Those swings trigger algorithmic responses. Algorithms amplify volatility. Additionally, and this is where marketing becomes predatory, ETF issuers created hundreds of thematic ETFs. AI-focused ETFs, cybersecurity ETFs, blockchain ETFs. Sounds sophisticated. In practice, they're sector concentration with higher fees marketed as tactical exposure. You might pay 0.65% annually for an artificial intelligence ETF instead of 0.03% for a total market fund because a marketing team convinced you that betting on one sector equals sophistication. It's the mutual fund playbook with better tax treatment and worse concentration. The underlying structure improves on traditional mutual funds, but product proliferation creates new ways to overpay for risk you didn't understand you were taking. And finally, here comes the exclusive club, hedge funds. And let me be direct. If you're watching this video, you probably don't need one. Here's what defines a hedge fund. It's a private investment vehicle with broad discretion and minimal disclosure requirements. Managers can go long or short, use leverage, trade derivatives, employ complex multi-strategy approaches, maximum flexibility, minimum transparency, extreme fees. And here's the reality. That flexibility only creates value if the manager is exceptionally skilled. And finding one consistently skilled manager among thousands is nearly impossible. Because hedge fund managers need to outperform passive indexing by enough to justify fees of 2% annually, plus 20% of profits, which means they must beat the market by 4 to 5% every single year just to match what you'd get from a basic index fund after cost. Most don't achieve this consistently. Some beat the market for 3 years, underperform for 7, then shut down. The survivors were skilled, lucky, or adept at managing how performance gets reported. And access requires accredited investor status. You must meet wealth thresholds indicating, according to regulators, that you can absorb substantial losses without protection. That's the actual regulatory logic. You're wealthy enough that you don't need investor safeguards. If you don't qualify for legitimate hedge funds, you might be offered alternative strategy mutual funds that attempt to replicate hedge fund approaches without the flexibility or talent pool. Legitimate hedge funds serve ultra-high net worth investors and institutions with sophisticated due diligence capabilities. For most everyone else, they represent expensive exposure to strategies that statistically struggle to justify their cost. So which fund is rigged the most? It's not the one with the highest fees. It's not the one with the worst underperformance. It's the one that catches the most people in the trap by pretending to be safe. Index funds. Here's why. 90% of 401ks are index funds. You don't have to actively choose them. The system chooses them for you. Automatic enrollment, default option, silent concentration. Low fees hide the fact that concentration risk is at historic highs. 7 stocks, 30% of the index. Every contribution you make automatically buys more expensive companies at scale. Mutual funds are rigged through underperformance. You can see it, you can avoid it. ETFs are rigged through behavioral traps. You can identify them, you can choose different ones. Hedge funds are rigged through fees. Only the ultra-wealthy are exposed. But index funds? The rig isn't visible. That makes it the most effective one. It's embedded in the system. It's presented as safe. It's automatic, and it concentrates your risk while feeling diversified. That's why index funds are rigged the most. Not intentionally, but systematically. What to consider? Here's what most people don't realize. Simple portfolios generate almost no commissions. Complex portfolios generate fees at every layer. The more sophisticated your portfolio looks, the more money flows to the financial services industry, and the less ends up in your account. Then there's the thing nobody mentions, your actual all-in costs. Not the fund expense ratio, your real costs. Advisory fees, fund expenses, trading costs, tax drag, platform charges. The industry never adds these up, but they do. And they usually total 2 to 3% annually. That gap between what you think you're paying and what you're actually paying, that's where your returns disappear. That's why understanding the mechanism matters. Not to follow specific advice, but to ask better questions when you're talking to someone managing your money. Consult with a licensed financial professional before making any investment decisions. The 4 fund types all have structural problems. But index funds catch the most people because they feel the safest. Market cap weighting, automatic enrollment, low fees masking concentration makes them the most effective and dangerous trap. Index funds rigged by design, not by malice. You can't see the mechanism, so you can't protect yourself from it. If this breakdown helped you understand what's actually happening in your portfolio, subscribe for more financial explanations that prioritizes clarity over sales. See you in the next one.